In the last 48 hours, something happened in the gold market that most people would call impossible if they saw it written on a chart. Not because the spot price printed a dramatic candle, not because a celebrity investor made a loud prediction, but because the plumbing underneath the price was forced to tighten twice, while real buyers began paying extra just to get metal in hand. 99 to 150,000 yen per lot. Then, only 3 days later, on February 6th, it tightened again, raising that margin ratio to 18% and lifting the price limit again, while also tightening silver's margin and limits. 2 announcements, 1 week. That's not a routine adjustment. That's a market operator signaling that volatility and risk are building fast. And here's the part that should make you sit up. While the paper world can still quote you a single global number called gold, physical hubs in Asia have been swinging from discounts back into premiums. Reports out of early January showed gold trading from a small discount to a premium in Singapore and up to a premium in Hong Kong. Those are not massive numbers per ounce, but they're a signal. Because when you see premiums appear, it's the market whispering that availability is not the same thing as price. They said this could never happen in modern markets. They said gold is too liquid, too deep, too global. They said the price reflects everything. Yet in real time, the price can say one thing and the cost to obtain metal can say another. Institutions already understand this. Most people don't, because most people are trained to watch the screen, not the strain. What I'm about to reveal changes the way you interpret every gold headline you see from this point forward, because rising physical premiums are not random. They are often the first visible crack between the world of paper promises and the world of deliverable metal. Welcome to Meridian Ledger, where we decode what matters before it becomes obvious. If you like calm, data-driven breakdowns that connect market mechanics to real-world consequences, you'll feel at home here. And if you've been watching this market from anywhere in the world, drop a comment with where you're listening from, because the physical gold story looks different depending on your geography. Now, let's reconstruct what actually happened, with forensic detail. The first clue is not the premium itself. The first clue is the behavior of the exchanges. When an exchange raises margin requirements, it is doing one thing above all else, forcing more cash to back each contract. That reduces leverage. It reduces speculative capacity. It also reduces the number of players who can stay in the game during volatile periods. When an exchange widens or adjusts daily price limits, it is acknowledging that price swings are becoming more likely, and it wants guardrails that can absorb bigger moves without triggering chaotic halts. On February 3rd, the Shanghai Gold Exchange didn't just nudge one product. It adjusted multiple gold contracts, AU T plus D, MAU T plus D, AU T plus N1, AU T plus N2, and specific New York-linked contracts, raising their margin ratios and price limits. In 99, a contract tied to high-purity physical gold. Then, on February 6th, it tightened again. Gold contract margins went from 17% to 18%, and the price limit from 16% to 17%. Silver was tightened in parallel. That sequence matters, because exchanges don't do this out of boredom. They do it when stress is building. And stress does not always show up first in spot. Often, it shows up in the cost of carry, in the willingness of counterparties to extend credit, and in the demand for physical settlement. Here's the abnormality. If gold were functioning as a perfectly unified market, the premium you pay to acquire physical metal would track close to normal, especially in major hubs. But the moment volatility rises, and the moment more people want certainty rather than exposure, the premium becomes the price of certainty. So why are physical premiums rising fast? Because gold is not one market. It is several markets stitched together by trust, logistics, and financing. There is the futures market, where contracts are overwhelmingly rolled and rarely result in physical delivery. There is the over-the-counter market, where large institutions trade bars and swaps and forwards. There is the wholesale physical market, where kilobars and 400-ounce bars move through vault networks. And then there is the retail market, where coins and small bars require fabrication, distribution, and a dealer network that must manage inventory risk. When stress rises, those stitches pull. The hidden pattern shows up across history. It's not new, it's just forgotten every time calm returns. In 2008, the financial system seized. The price of gold moved, but what mattered was that the normal credit machinery froze. Dealers struggled to source product, and premiums on popular coins widened because the bottleneck wasn't gold in theory, it was gold in the sizes people could buy, delivered through strained supply chains. Result, the paper price could lag the reality on the street. In 2011, during the European sovereign stress era, gold surged and volatility rose. Exchanges and brokers tightened terms. Some markets saw big gaps between bid and ask, and retail products carried meaningful premiums. Because fear is always expressed through immediacy. People don't want exposure, they want possession. In 2020, when the world shut down and refineries, flights, and logistics were disrupted, The most dramatic dislocation wasn't just the price move. It was the spread between markets. Wholesale bars in one format traded differently than another. Transportation constraints and refinery throughput became price drivers. Result, gold became plural again. And now, in early 2026, we see the rhyme. Rapid tightening of margin and limits in a major exchange. Ecosystem, alongside signs of physical premiums re-emerging in important Asian hubs. The pattern is the same playbook. The details change. The mechanism doesn't. Now, let's talk about the players, because this is never just about retail demand. There are the exchanges, which set the rules of engagement. When they raise margins, they are managing systemic risk. But they also shape who can participate. Higher margins push out the weakest hands and reduce forced liquidations later at the cost of near-term churn. There are the bullion banks and large dealers who live in the interlocking world of forwards, swaps, and leasing. They don't think in coins, they think in bars, financing rates, and inventory flows. When volatility rises, their risk managers tighten limits, and that tightness filters downstream as higher spreads and higher premiums. There are the refineries and fabricators. Their capacity matters. A 400-ounce good delivery bar is not the same thing as a 1-ounce coin, no matter what a spot quote implies. Converting large bars into small products requires time, capacity, and logistical stability. When demand surges or uncertainty rises, that conversion becomes a bottleneck. There are the central banks. 3 tons, with Poland reported as a leading buyer at 102 tons. That is not retail, that is policy, that is reserves, that is long-term positioning. And it matters, because central bank demand changes the baseline flow of physical metal. When large official buyers are active, they can reduce the pool of available metal in the wholesale system. Not because the world is running out, but because the marginal bar that would have been available for lending or swapping is now sitting in a vault as a strategic asset. Now add the consumer layer. Reports on Chinese demand in 2025 described enormous bar and coin buying, driven by a retail investor class that has learned to treat metal as a store of value when property and equities feel less reliable. Again, this is not a prediction. This is a pattern. When local buyers prefer physical savings vehicles, local premiums can develop because they are absorbing flow. So you have the official sector absorbing large tonnage, and you have consumer sectors absorbing retail bar and coin supply, and you have exchanges tightening margins as volatility rises. That is the setup. And the dislocation is the consequence. Here's the dislocation in plain terms. That is a number for an instrument, often a futures contract, settled financially most of the time. That something is the premium. And that premium expands when 3 things happen at once. Demand for immediate delivery rises, supply of immediate deliverable product tightens, and the risk of holding inventory increases. Think of it like airline tickets. A price index might tell you the average cost of flying, but try buying the last seat on the last flight out of town during a storm. Suddenly, the average is meaningless. You are paying for scarcity, urgency, and risk. That is what premiums are. Now, a skeptic might say, premiums always exist. Yes, normal premiums exist, and they vary by product. But the key is change. When premiums rise rapidly, the market is telling you that the marginal unit of physical gold is more valuable than the marginal unit of paper exposure. And we can see this even in retail pricing behavior. In the United States, for example, dealers often quote American Gold Eagle coins at a premium above spot, and tracking sites have long shown typical ranges in the mid-single digits depending on conditions. The point is not the exact number at any given hour. The point is that the premium becomes elastic in stress. It can expand quickly when demand spikes or supply tightens. It becomes a pressure gauge. Now, let's bring the evidence together with numbers and mechanics. First, the exchange tightening. Going from 16% margin to 18% margin in a matter of days is not a cosmetic tweak. If you control a position, that is more cash tied up, less leverage, and more forced risk reduction. For anyone operating at the edge, 99 margin to 150,000 yuan per lot is a direct increase in the capital required to carry exposure tied to physical gold. Second, the premium signals in Asia. Singapore moving from a discount to a premium, and Hong Kong showing premiums up to the reported range, tells you that in those hubs, immediate physical is being bid for more aggressively than the global benchmark implies. Again, the size of the premium matters less than the direction and persistence. A premium is a localized vote on availability. Third, the macro flow. 3 tons in a year is not a footnote. That is structural demand, and it reduces the flexibility of the system. You don't need a shortage story. You only need a story about the marginal bar, and who holds it, and whether they are willing to lend it. Now, the most important part, why these gaps cannot persist. A dislocation between paper and physical is a kind of market tension. If physical stays expensive relative to paper, arbitrage should eventually close the gap. But arbitrage requires two things: the ability to source metal and the ability to finance it. When those become harder, because margins rise, because credit tightens, because logistics are constrained, the arbitrage mechanism weakens. And when arbitrage weakens, the gap can last longer than people expect. This is the part no one is discussing. The premium is not just a retail phenomenon. It is a symptom of how easily the system can transform paper claims into physical delivery when stress rises. So how is this executed in practice? How does a premium rise fast without a dramatic spot move? It happens through the mechanism of risk and inventory. Dealers hedge inventory using futures or forwards. When volatility rises, the cost of that hedge changes. When margin requirements rise, the cost of holding that hedge rises. When credit lines tighten, the ability to finance inventory shrinks. So a dealer who used to hold a certain amount of product comfortably now has to decide, either hold less inventory or charge more to compensate for the risk of holding it. At the same time, buyers who previously were happy with exposure, an ETF share, a futures contract, a digital token, decide they want the thing itself. Not because they are panicking, but because they are repricing counterparty risk. That increases demand for physical delivery. Now add the bottleneck of fabrication. Coins and small bars require manufacturing capacity. If demand spikes, mints and refineries hit limits, back orders appear, delivery times extend, and a longer delivery time is not neutral. It is a risk that someone else has to carry. That risk gets priced into the premium. If you want an analogy, imagine a supermarket during a storm warning. The sticker price of bottled water on the shelf might not change instantly, but the real cost of obtaining water, time, travel availability, changes immediately. People pay more at the store that still has stock. They drive farther. They accept higher prices for convenience. That is what is happening when premiums rise. The benchmark price is the sticker. The premium is the reality tax. Now, let's connect the dots between timing and coordination, because it's not about secret meetings. It's about aligned incentives. When a major exchange tightens margins, brokers tighten client terms. When brokers tighten client terms, leveraged speculators reduce positions. When positions reduce, volatility can spike in the short term because liquidity thins. When volatility spikes, more risk managers tighten. This is a reflex loop. At the same time, if physical demand is steady or rising, driven by central banks, by Asian consumer, flows by investors seeking certainty, the physical market remains supported. So you can have a scenario where paper positioning is forced to shrink while physical demand remains firm. That can produce strange outcomes. Spot price may not explode, but premiums can. This is where it gets interesting. In a world trained to interpret one price as truth, the premium becomes the message the market uses to tell you the truth is more complicated. Let's slow down and unpack why a premium can erupt, even when the headline quote looks normal, because this is where a lot of smart commentary goes wrong. That sounds logical, until you remember how prices are discovered. The benchmark is discovered where volume is highest and leverage is easiest. Physical tightness is discovered where delivery is hardest and certainty is most valued. Those are not the same arenas. A futures contract is a tool for exposure. It is brilliant for hedging and for taking a view, but it is also built for netting. Most contracts are opened and closed without delivery. That means the benchmark price is not forced to express the cost of fabrication, freight, insurance, and immediate allocation. The premium is where those hidden costs surface. Now connect that to rising margins. When margin requirements rise, the market is demanding higher quality collateral for the same nominal exposure. That raises the opportunity cost of every leveraged position. Some players reduce exposure, some widen spreads, some stop making markets as aggressively. Liquidity thins, and the benchmark becomes more financial, even as the physical chain is dealing with very practical constraints. Because the physical chain has links that cannot be wished away. Metal must be refined into acceptable forms, assayed, fabricated, transported, and stored. Each link depends on time and credit. If a refinery is at capacity, if shipping lanes are tight, if insurance costs jump, or if dealers can't finance inventory as cheaply, the premium grows. None of that requires a dramatic spot move. It requires a change in the cost and speed of turning demand into delivered metal. This is why you can see a contradiction. Commentators debate whether gold is overbought, while wholesalers quietly quote tighter availability, and retailers quietly lengthen delivery estimates. The debate happens in the loudest arena. The shift often happens in the most practical one. Geography matters too. Premiums often flare first where buying is culturally normalized and distribution is dense. In parts of Asia, gold is a savings habit, not just a trade. Local buyers can bid up physical, even if global funds are reducing paper exposure. That's the East versus West contrast. One side treats gold as a macro instrument, the other treats it as an object on the balance sheet. When those motives diverge, the gap becomes visible. And there's a second contradiction. Central banks can be buying, while some narratives focus on rate expectations or a strong currency. It means different actors are optimizing for different risks. A reserve manager isn't chasing quarterly performance. A reserve manager is managing credibility and liquidity across decades. When that kind of buyer stays active, the market's underlying floor can become sturdier than the daily debate suggests. Put it together, and the premium becomes a translation tool. It translates stress into a number that doesn't show up in the spot quote. It translates the desire for deliverability into a cost. That question is the difference between watching the market and understanding it, because the most important moves rarely announce themselves with fireworks. They announce themselves through frictions that quietly widen, then suddenly reset the entire playing field for everyone involved, overnight. Now, what does this mean going forward? Not as a prediction, as a historical pattern. Historically, when exchanges tighten risk controls and physical premiums reemerge, one of three broad paths tends to follow. In the conservative scenario, volatility cools, margins stay elevated for a while, and premiums slowly compress as fabrication catches up and risk appetite returns. The dislocation fades, and the market returns to behaving as if gold is one unified thing. In the moderate scenario, the premium persists because the underlying demand, official and consumer, remains strong, while financing conditions stay tight. In that environment, the benchmark price can move in fits and starts, but the premium acts like a floor for real buyers. You see repeated episodes where physical stays bid even when paper sells off. In the aggressive scenario, the gap widens because a shock hits the system, a funding squeeze, a sudden rush for delivery, a logistics disruption, or a volatility spike that forces even more tightening. In that environment, the market reprices not just gold, but the confidence in the pipes that deliver it. Premiums become a headline, not a footnote. What should be watched specifically? Watch margin and limit announcements from major exchanges. Those are the mechanical signals of stress. Watch reported physical premiums in major hubs, especially when they flip from discounts to premiums. Watch the behavior of official sector demand over time, because sustained buying reduces the slack in the system. Watch delivery times for retail products, because long lead times often appear before premiums fully adjust. And watch one more thing: the difference between calm narratives and mechanical actions. When the story is nothing to see here, but the margins are rising, the market is telling you that risk managers disagree with the story. This is the divide. It's not about being smarter than anyone else. It's about paying attention to the signals that the market itself produces. Most people see a spot quote and think they are seeing the whole market. But the market reveals itself through frictions, margins, spreads, limits, premiums, and delivery times. Those frictions are not noise. They are information. Institutions move first because they have to. Their risk controls force them to respond to volatility and funding conditions immediately. Retail reacts last because retail is shown the price as entertainment, not the mechanics as warning. If you understand that, you start to see why rising physical premiums matter, not because they guarantee a certain price path, but because they reveal a shift in what the market values. Not exposure, but certainty. Not theory, but deliverability. Not a number on a screen, but a chain of custody. This is Meridian Ledger, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And the question isn't whether markets go through these stress cycles. The question is whether you recognize the signals early enough to understand what's really happening when everyone else is still arguing about the spot price.